Welcome to this week's series of Credent Connect, and today we're going to talk about the activity in the markets and the volatility we're experiencing as what has been dubbed the Liberation Day or tariffs announcements from President Trump and the Trump administration. And it's really important to note here that this volatility that we have seen at such a quick pace, such a dominant pace, has been wide felt, meaning often during such cycles, there tends to be this notion of a bubble, meaning a concentration in the market that pops, that causes chaos, or something that is rather unforeseen in one segment of the market. What we're seeing this time around is actually a more uniform downside. And as counterintuitive as this may sound, that's actually healthier than seeing a bubble burst in the market that causes unforeseen chaos. As we're looking at this volatility from a portfolio construction standpoint, from a risk management standpoint, and we're going to talk about the specifics of how we're actually managing and what we're doing there. But before we do that, it's really critically important to note that as an investment platform here at Credent, we have lived through numerous cycles and managed numerous of such cycles in the past. Starting with 2013 in the European debt crisis as that was unfolding in the later stages, with the Japanese near implosion of the stock market that actually turned around to be a positive for the Japanese stock market. As we look at the 2014 to 2016 earnings recession, right, where there was a nearly 0.1% growth in aggregate earnings, where we managed through that and provided tangible positive results for our clients. As we look at the 2018, the latter half of the technology notable decline in the markets, as we look at the COVID downturn that we managed through, as we look at the 2022 bear market, these are all things that the investment platform has lived through, managed through, and provided tangible value for our clients. And all of it is showcased and the data provided in our third-party verified investment performance results. So with that in mind, here we get at another kind of impasse in the markets from a volatility standpoint. And what's really interesting here is that it is very easy to feel as if this is the first time volatility has happened, or if it's the first time volatility has happened in such a severe manner. The reality is this is the normal cycle of the markets, right? This is the short-term volatility that pays to be a long-term equity market participant across U.S. and international markets. So it's really critically important to note that from that standpoint. But as we are looking at the markets today, and as we're looking at reality of what's happening, we want to address kind of how the portfolios are structured and the risk management backdrop within that. So Alicia, I'm going to turn it over to you. Talk to us a little bit about the aggregate indices, and then how does that even compare to the aggregate portfolios and strategies here internally for our clients?
So one of the most important things to understand is that the volatility in the indices is not the volatility that our clients are actually experiencing in our Credent invested portfolios. And there's a handful of reasons for that. First, indices are mostly market cap weighted, meaning that they are heavily concentrated in the largest names of the index. Right now, if we look at the S&P 500, because that is, the premier index in the U.S., the top 10 names make up 30% of that index. Those are also the names that are having a lot of that downside volatility. Right. We are not structured in that way. We take more of an equal weighted approach throughout our portfolios, so we don't have that concentration risk.
Yeah, that's a good point.
A couple other things that we're doing in place. We came into this underweight mid and small cap. Mid and small cap has really gotten beaten up, and we haven't participated that much on the downside for that segment. And we also have flex in place. So we've taken off some equity market participation off the table, bought some T-bills to lower that downside capture. Mm-hmm. And so we're sitting pretty nicely. And we've added to that over the past couple of days, most recently Friday morning. So we missed, again, some of that volatility to the downside on Friday and coming into Monday morning.
Yeah, it's, we thrive at this type of environment and being very proactive, not reactive. I think being reactive tends to cause more chaos than being proactive. What Alicia's mentioning is, as the media is flashing these big -5%, -6% numbers on an intraday basis, meaning activity for that day, it's easy to assume that that's my personal rate of return across my portfolios or across my entire household. The reality couldn't be more different as it relates to the fact that we are notably diversified. We are notably underweight those individual asset classes that have seen some serious downside, and we're continuing to be very, very proactive in that space. The added benefit in the structure is taxes. Give us a little bit of purview into that from that standpoint.
Thursday, Friday, and again today, we are looking at tax loss harvesting opportunities. So when we have a decline in a particular stock, we're able to sell it, harvest those losses, and immediately go invest into a similar asset to maintain that exposure. So what that means for our clients is we're taking those losses to offset future tax gains. So a big benefit for our clients and the eventual taxes that they'll have to pay.
Yeah, and we're doing it without exiting equity market participation. We're simply swapping. And it's that balance that you've heard us talk before of focusing on not only an investment return profile, but also an accounting return profile. Those are very, very important components that go together extremely well. And lastly today, kind of one thing I want to kind of maybe end this with here, this Credent Connect series today, is kind of a forewarning in the sense that the economy and capital markets, meaning the stock market, the bond market, the commodity market, all of those components, they never truly react in a way the masses expect them to. Meaning, if we're all holding hands and agreeing that we're maybe going into a recession and more volatility and X, Y, and Z, when there is this cohesive belief that something's going to transpire, those rarely occur in such a manner moving forward. Year to date is a fantastic example, what we talked about a couple of weeks ago, in the sense that everybody thought international markets were going to fall off a cliff as President Trump entered office. The reality is that those international markets have outpaced U.S. markets by 10%. If we go back during COVID, during the depths of COVID in late March 2020, probably a very vivid memory for many of you, the expectation was that the downside was going to be even worse than that 35-40% peak to trough experience that we saw. The market recovered almost immediately, with every economist and every analyst missing the boat. All this is to say is that attempting to time or attempting to gauge what may happen simply because the masses are expecting something to occur is often a great recipe for disaster and a great recipe for missing the potential upside that may transpire over the next 6 to 12 months. So with that in mind, stick to your financial plan, allow our risk management process to take place. It is working extremely well thus far. We're being very proactive in this process, and we look forward to the eventual recovery that we do believe we're near that bottoming out process, but that eventual recovery, we are preparing for it, and we are going to deliver on that as the markets transpire.